Hello, chart watchers, and welcome to this Wednesday, November 14th Market Watchers live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we've got the Dow Jones Industrial Average down 76 points, extending the recent slide. The S&P 500 down 6.6 points. The NASDAQ currently down 21, and the Russell 2000 down 4. So we've got weakness across the board. 10-year Treasury yield continuing to slump. We now have that down at 3.13%, getting pretty close to the low that we saw on the other side back in the second week of October at about that 3.12% area. This would be an area I might look for a reversal here. Haven't had a whole lot of economic news out, but we will be getting more later this week. Volatility index back on the move higher. It was down earlier this morning, but it has rallied. We're back up to 20.79. To the downside, utilities leading down more than 1%. Financials also struggling a little bit, as you can see, trending lower after the recent uptrend. Technology back down close to the lows we saw at the end of October. So technology on a relative basis certainly not performing very well. The property and casualty group within the financials leading to the downside. You can see that this is a group that is losing its 20-day moving average today on this weakness. Also, after breaking out above the 790 level, that should have been holding as support. So double negative here for property and casualty. To the upside, discretionary hanging on barely to a gain after a gap up earlier this morning. And the clothing and accessories area, I believe gambling stocks were actually the number one performing industry group within discretionary. But clothing and accessories also performing well. But after gapping up and moving higher earlier, it looks like we're getting a reversal here as well. All right, Erin, it's Wednesday, hump day. And, I posted something in my blog article. I don't know if everyone out there is aware of this. But since 1950, Wednesdays have been the best day of the week, the calendar week for the stock market. It's actually Wednesdays on the S&P 500 have produced annualized returns just over 20%, which is more than double what the S&P has done throughout the year over the last 68 years. So for what it's worth, the market likes hump day.
All right. And we'll see about not today. I don't know.
Yeah. Not so much today.
A lot of people have asked about the seasonality coming up in November, December. So you'll have to expand on that for us soon.
Yeah, I definitely will be talking about it. I mean, mostly fourth quarter tends to be very strong for equities. We're actually in that period from October 28th to January 18th, which is the best almost 3 months of the year. I guess it's about 2 months and 3 weeks or something like that. But yeah, we're in the midst of it. You wouldn't know it by looking at the market, but historically, this is a pretty good time of the year. And today we do have a special guest. Bruce Fraser's back with us. Bruce, we got so many things going on in the market. I know you got all the answers for us. Welcome back.
Well, thank you. Great to be here. I have no answers. Sorry, but I am happy to be here.
All right. Well, that's the end of the show. Everybody have a good day. I had no better than that. You got something for us, and I can't wait to hear it. And we're going to bring you back in about 15 minutes. So if you don't mind sticking around, that'd be great.
I'll be here.
All right. Erin, what do we got today?
All right. Coming up, upcoming schedule, though, we got Julius de Kempenaar. He'll be talking RRG tomorrow. Greg Schnell will be coming in next week. I have a workshop next week. I've got to figure out what I'm going to do it on. And then, of course, Thanksgiving, we will be closed for business as far as Market Watchers is concerned. No Market Watchers on Thursday or Friday of next week. Today, we do have Bruce Fraser in. And I know he's going to have some interesting Wyckoff to talk for us. Johnson & Johnson, J&J, is going to be our first 10 in 10 stock. And we will finish off the program with agree or disagree. Recommend if you are watching live, if you go in and take the poll on the agree or disagree, we're going to be pulling that up to see if you agree or disagree with our panel. All right, let's go ahead and get started with technical news and headlines. What you got?
All right, well, a couple of economic reports out this morning. Well, mostly it was just inflation report, but we got the CPI and the core CPI, and you can see both matched expectations, which was actually a little bit of a relief because we did see the producer price index come in well above expectations at the end of last week. So I guess maybe a little bit of a relief that the CPI and core CPI matched expectations. So we didn't see all the I don't know how you want to call it, but the hot inflationary report that we saw at the end of last week did not carry over into the consumer numbers. So that at least was maybe a little bit of a positive for the market. We did see the 10-year Treasury yield move up a little bit earlier today, but it is now back down near the low. You can see on the chart, we got up to the 20-day moving average, failed. We came back down. Currently, we're down at 3.13%, which is almost 2 basis points lower. We nearly broke out, tried to get up to that 3.25, 3.24 area just about a week ago. We couldn't do it, and now we have since pulled back. I am looking at the market right now as mostly in just sideways consolidation fashion after that uptrend. So I think if we break below 311, 312, which is held for the most part, then I think we could bring in these recent lows, the one at the end of October and also the one at the end of September into play. But a lot of it will depend on the economic reports out the next 2 days, and we do have a bunch of those. Let's move on to earnings. I know that earnings season certainly is slowing down, but we have a lot of earnings out there. So let's start with a couple of the cannabis stocks. Tilray and Canopy Growth both came in today. Tilray beat expectations, although it did post a loss of 8 cents. Canopy Growth, though, was well below expectations. And sandwiched in the middle there, you can see Macy's, a broadline retailer, which nearly doubled expectations. That one bothers me a little bit because they came in about as expected top line. They beat on the bottom line. They raised their guidance, and the stock was struggling earlier today. We'll take a look at that chart in just a couple minutes. Canada Goose Holdings blew out expectations, raised guidance, and they were threatening a breakout, although they were well off their earlier high. We'll look at that in a bit. And then tonight, big report, Cisco reports after the bell, along with Network Appliance, which is in that computer hardware space, is actually, until recently, had been a very, very strong relative performer in the market. So I'm sure traders will be anxious to get those reports. All right, let's take a look at Tilray first. This one, down quite a bit today, 7.6%. Let me get an update because it is volatile. I'll make sure I got the latest, 7.8%. The stock had just bounced back to 140. The recent low was down at about 85. That's a wide range, but this is a very volatile stock, and we are sitting almost in the middle of that range, maybe a little bit toward the lower end of it. I think it's difficult to say. I'd say overall, you've got this declining tops trend line. And so, or maybe you could argue that it's a little bit of a wedge off of an uptrend. So I guess you can make arguments both ways. But what I would take away from this stock is that there's a lot of volatility, and you got to be willing to accept a lot of risk to trade this particular stock. Let's see, Macy's. Let's pull Macy's up and take a look. Yeah, look at the earlier move to the upside and where the stock is now. I mean, when you take a look at the numbers on this report, $5.4 billion in revenue. That's what the market was looking for, and their expectations came in or met way above their expectations on the earnings side. 27 cents versus 14 cents. They raised their guidance. The stock was up about $1.25, maybe $1.40 earlier in the session, and now we're seeing it down 5%. It just makes me wonder if a lot of the good news is already built into the price in some of these shares. I mean, if we go back and take a look, let's say for the last couple of years on Macy's, you can see a huge run up. And so maybe we're going to go back down to around this 32 level and just continue to consolidate. I think overall, this is a bullish, pretty bullish looking chart. I would continue to watch key area, which is at, I'm going to say right at about that $32. That's where top was. We gapped up on heavy volume in May, went through it, and just recently came back down and tested this area at 32 or maybe just below. So I think you got a couple of key areas to watch and a trading range established from about $32 up to almost $42. And with this report, which again, I think is pretty positive, we are getting a negative reaction. I think that the stock probably becomes a pretty good buy as it gets closer to that 32 level. All right, let's take a look at Canopy Growth, another one of the cannabis stocks. And let's see what this chart is looking like. They missed by a pretty wide margin on their revenues, 17.9 million versus 25 million expected. And yes, that's million. 25 million was expected, 17, almost 18 million was the actual number. So we're not talking about a very big company here. And their earnings came in at a loss of 76 cents. market expecting just 12 cents. I don't know if those numbers are comparable, but those are the numbers I saw. And you can see the market not liking it. Stock down 11.5%. It's got pretty good support down around the $32 level. And I would say at this point, it looks like it's probably heading down there. Overall, volume trends pretty weak since we topped out in mid-October. So I would expect maybe 32 in the cards here for CGC, and then we'll see what happens from there. Canada Goose Company, GOOS, really good report here, but I don't like this candle. The numbers, 230.3 million in revenue, market expecting 198, so easy beat on the top line. And by the way, those are Canadian dollars I gave you. And then bottom line in US dollars, 35 cents versus 19 cents. So a really big beat, huge gap. They did raise guidance, by the way, but we had an easy breakout above that June high on very heavy volume. And so far, that is a shooting star candle or an inverted hammer. And that doesn't bode well in the near term if that sticks into the close. In fact, if I was holding into the earnings report and I got this move up and the failure on the breakout at this point, I'd probably take my profits and move on. See if you get a pullback. I think 62, maybe even back down below 60 could be in the cards if we can't get this breakout into the close today. All right, I know, Erin, you've got a number of upgrades, downgrades, and we're going to get into Bruce's talk here in a few minutes. So why don't you take it away and let everyone know what you got today?
All right, absolutely. Some interesting information to give you today on our upgrades, downgrades. All right, let's start with our upgrades. Amarin Corp, upgraded by Citigroup from a neutral to a buy. I would certainly not be buying this. I suspect, if you want to take a chance on that falling knife that we can see here and try and get in here on either this area of support, you can see where it closed back here at the beginning, when it gapped up. So I think that could be considered an area of possible support. After that, the gap support. But honestly, I'm not liking this chart at all. Look at the failure of the PMO. It's still moving downward. I just don't see anything really good on this chart despite getting that upgrade. TD Ameritrade, Morgan Stanley upgraded it from equal weight to overweight. I think there is some promise here, but I would need to see a breakout above this overhead resistance. The PMO has turned up and it does look like it wants to continue forward. And you can see even the scooter is starting to make a little bit of a move to the upside, although I'm not really thrilled with the volume pattern at this point and the OBV as it's heading downward. So look for the breakout here, but wait for it if you're interested in getting into TD Ameritrade. Excuse me, Bluebird. Upgraded today from a market perform to an outperform by Bernstein. It's getting ready to hit some very important support, I would say here. You have to go back to the weekly chart to really see. But before I get to the weekly chart, things I want to point out as problems here, despite the upgrade. PMO that is topped below the signal line. You've got the OBV and scooter both moving lower. Pretty hard to imagine that this one isn't going to continue down to at least test that support level over there. And if you look really quickly at the weekly chart, you can see that we really need to hold that area right here at that gap we had previously. There's not a lot here after that as far as looking for good support. And you can see the PMO is heading in the wrong direction. Tapestry was upgraded today from a buy. PMO buy signal is here. Sorry, I'm looking at that buy signal. I'm so excited. Tapestry Atlantic Equities upgraded it from neutral to overweight. I like this PMO. We do have the buy signal in oversold territory. The PMO was trying to head back down, but it looks like it wants to bottom above the signal line, and that's always a good sign. But again, there's a lot of overhead resistance out here for a lot of these stocks, and I would have trouble buying in to even an upgrade here because the overhead resistance is right there. All right, let's look at Apple. This one was downgraded. Apple was downgraded by Guggenheim from a buy to a neutral. The FAANG stocks have been having some big problems lately, and Apple is certainly one of them, leading the Dow to the downward. The problem I have with Apple here, there's a lot of problems. The PMO is still looking very ugly. And in fact, if you look in the thumbnail, it looks like it's even accelerating downward. It is very overbought, but here's the important area of support. We already broke down through some intermediary support at that gap. So we've closed the gap. So that could offer an opportunity to turn back up after closing that gap and find support at 180. It needs to find support at 180. If it doesn't, I would look out below. I think it'll move even lower. Kellogg, our consumer staple. JP Morgan upgraded or downgraded it from an overweight to a neutral. Being in the consumer staples area, October was a difficult month. You would have expected to see this one really perform and continue to perform given the decline we're having in the markets, but not so. It has hit some important support. I've marked it at right here at this low from February, from a close that was back here in June. It all matches up nicely with today's intraday low. Watch this one carefully. The PMO is accelerating downward, and I do not like that. So we want to keep an eye on that as well. All right, one more to go over for you. And there's a little bit of backstory here. PG&E Corp, really ugly chart, isn't it? Here's the reason why. Both Edison, EIX, and PCG, these were both downgraded today. These companies are right now being looked at for mismanagement, excuse me, of the power lines that caused this California fire. Right now, I guess today, actually, there was a woman who had called in and said that PG&E had called her to say there were sparks coming from power lines near her, and that was a day before the fire started. So they've now marked her house as a crime scene, and I would expect these stocks, Edison included, to continue lower. And I'll just show you Edison really quickly here. You can see very similar pattern here. This happens to be my electric company. But you can see that we've got a very bad PMO. It's heading lower. I think that Edison looks a little bit better, and mainly because they're not really the target of this recent investigation with, like I said, this particular witness. So we'll have to see where this one goes. But very interesting developments here as far as the start of the California Woolsey fire and the Camp Fire. So it's going to be interesting to see how this plays out. But I wanted to certainly inform you why we're getting these downgrades and to certainly keep away from these stocks, I would say, in the future. Could find some support. We hit some very oversold levels, but I just wouldn't be taking a chance. All right, and that concludes the upgrades and downgrades. Here are the ones that I went over, and there were a few extra upgrades. We had Aramark, ARMK was upgraded, Holysys, HOLI was upgraded. You can see that also downgrades, there's what I covered, but other downgrades, ConAgra was downgraded, Edison, as I talked about, EIX, Corvo, and Sangamo Therapeutics, all of them downgraded today. That's all I have. So let's go ahead and Bruce, it's time to bring you in. I know everybody is waiting breathlessly to see what you have to say.
Expectations are so high.
Always. You always meet them. Actually, you always exceed them.
Oh, okay.
As far as our viewers are concerned, they absolutely love your segments. So I won't take up any more time.
I am thrilled to be here, always. And two things. First of all, I'm a school teacher, and so I have a homework assignment, and that is that. So this is my blog from September 24th of 2015. So everybody go look that up, and it's distribution definitions, and you're going to see the distribution schematics and some description of them. And I want you to look at schematic number 1, and I want you to compare it to a daily chart of Canopy Growth, CGC, which Tom just talked about.
Hey Bruce.
Yes.
I'm not seeing the blog or any charts. I don't know if you're showing those. I just wanted to.
Oh, no, I was just going to have everybody go look at that. Are you seeing the first screen here?
Yes, power charting.
Yeah. Okay, good. I just was given that as a homework assignment.
Okay.
It's just it's just me, being me.
Okay. I just wanted to make sure that you weren't showing something that wasn't appearing on the screen. Go ahead.
Yeah, so they should be able to go into my blog and go into the archives and find that. And that's a really good one to print off those schematics and look at. But here, and also you can find a lot of that material here at, first of all, there's my blog on stock charts, and then there's also other Wyckoff education that you can find that's free content on the YouTube channel, which is there, and also at the website that Ramon has, wyckoffanalytics.com. Lots of good free content. So please go check that out as we talk more about Wyckoff. And then let's go. So what I want to do today is spend a few minutes sort of talking about what I think is a really important event that happened in 2018, which is in January, was the very sharp decline that we had after a big climax that occurred into the middle of the month, into the middle of January, and then a pretty sharp decline, which set up what we call a change of character. And really what we've had since is sort of a big, gigantic trading range. And, whether this is the beginning of, or this is the construction of some kind of distribution, or whether it's a reaccumulation or just a big trading range that's going to go on for a while, something really big and important happened there and has been taking place through the course of the year. And I believe this to be either a reaccumulation pattern or whatever that is being caused by rotation. And this rotation that's occurring is what I really want to talk about today, because if we can sort of embrace the idea that the market is in this big sort of a sea change, we can identify where money is flowing away from and where potentially it could be flowing to. And so I want to do this as sort of a story in three parts, which is here we see that in this chart, which is the S&P 500 from 1977 to 88. And underneath that is a relative strength chart. And the relative strength chart is really pretty straightforward. And that is, it's the NASDAQ composite compared to the S&P 500. And so this is really a discussion about growth versus value. And we identify the S&P as being sort of these big, mature companies that have been around for a long time that have, growth potential, but the growth potential is maybe modest compared to some of the really fast-growing NASDAQ type stocks. And so we're looking at the NASDAQ as being our growth index. The S&P is our value index. And arguably there are better ways to look at this, but I think that this tells a good story. And so you can see that when in the bottom chart, when the line is rising, that growth is leading. And so the rising line means that the NASDAQ composite index is outperforming the S&P 500. When the line is declining, it means that the S&P 500 is outperforming the NASDAQ composite. And so notice that from the late 70s into 1983, you can see that there's generally rising trend of growth type stocks relative to the S&P. And this was a period where there was a pretty deep recession back in 80 to 82. And then thereafter, a robust big bull market that occurred from 82 onward. And the thing is that if we're not really aware of what's going on between growth and value, we have the potential of being in the wrong place at the wrong time. And this particular chart is a really good example of that. So, and also this is about the time that I was very young in the business. I had just had become a financial person in the industry and was sort of floating in when the growth stocks were acting really, really well. And so you can see here in the 82 to 83 period that there's really just a dramatic blow off in this relative strength indicator. This was an IPO boom. And this was my first IPO boom that I experienced, and it was really quite dramatic. And this climax that occurred into the middle of 83 was came at approximately the same time as a correction occurred in the market. Somewhat of a gentle correction, but it was a correction in the market as defined by the S&P. And thereafter, there was a big, robust bull market from 84 to 87. So you can see, though, look what happened to the growth stocks. Is the growth stocks just tumbled. And if you had been heavily invested in growth type names in your portfolio back then, you had severe underperformance. And the place to be was in the more value-oriented, mature names that are dominant in the S&P 500. And so this is really kind of where I'm going with this today. And that this discussion really is about, are we in the process of going through a sea change where we're going from growth orientation or emphasis to a value emphasis? So the thing about the difference between the two and the environment that they both have is that growth tends to be an investment that is performs best when you have certain characteristics that are behind it in the economy. And one of them is that you have generally higher taxes. So, and this is not a political statement at all. This is just us as investors trying to understand the environment and what are the assets that can work best for us in that environment. So back in the 70s and into the early 80s, we had high taxes on capital. We had high taxes on dividends. We had high income taxes. Generally, this kind of an environment favors growth stocks because think about growth. Growth stocks are companies that have this great potential because they generally are smaller companies with good products, good innovative new products, where they can reinvest their capital and grow their businesses at a very high rate. The thing is about growth is that you can defer taxes on growth indefinitely into the future. You buy good growth stocks, you hold them for a long period of time, you create gains, but they're unrealized. You're not creating a tax event by holding these growth stocks. Well, what happened in the early 80s is that there was an emphasis, there was a change of taxation towards lower income taxes, lower corporate taxes, lower taxes on dividends. In other words, capital was taxed at a lower rate. And as a consequence of that, the thing that happened was growth had gone way, way up, growth themes, and they had become extremely overbought, and they had become very expensive. And at the same time, you had an orientation or a change from, because of taxation, more towards value-oriented investments, which benefit from low taxes. And so as a result of that, around 1982, you started to have a change of taxation, and at the same time, you had a blow-off in growth. Okay, having said that, let's move on. So here is a period from 1995 to 2005, and you can see that this was a dramatic bull market in the S&P 500. Well, notice this, around 1998, there was all of a sudden this big explosion of interest in growth stocks. Well, this was a period that was generally a period where taxes were somewhat higher, capital gains taxes had gone up, income taxes were generally a little higher, and so on, and growth all of a sudden took off, and you had this period of time and this was a huge IPO boom. This was the dot-com era. And so growth really just exploded towards the end of the bull market, in the second half of the bull market. And at that time, you had this blow off, and then both the S&P 500 and the NASDAQ composite both went down into 2002, 2003, where we had a change of orientation towards taxation, which tended to benefit value stocks. And so you can see that when this line is low and flat, that value stocks generally are doing better than growth stocks. And you can see here that this rising trend in the S&P 500 was benefiting the value names. Now, if you'd owned certain industry groups in this decline from 2000 to 2003, you didn't even notice that there was a bear market. And that was home builders, bank stocks, oil stocks, oil service stocks. There were home improvement. There were many groups that just didn't miss a beat. They went sideways for a while in the bear market, and then they started to go up on their own. These were deep value stocks and benefited from this change of environment. So now coming to the current period, this is from 2012 to 2018. You can see that the basic theme that we've had in this bull market has been growth. Growth has been dominant. You can see higher highs and higher lows throughout on this relative strength line going from 2012 to the present. And the S&P 500 has done wonderfully in that period of time. It's been a great bull market all the way through. But if you'd been in growth, you would have outperformed. It would have been a better place to be, or let's just call it the best place to be. And then what happened? So here we are. Let's look at 2018 here. You can see a climactic blow off in the growth relative strength line. And you can see that in January on the S&P 500, you can see this peak that we had early in the year, and then a sharp decline, change of character, and now we're in this big trading range. Well, what's the thing that happened at the beginning of January? Is we had a big tax change. And so we had a tax change where corporate taxes came down, taxes on capital came down, dividend taxes, and income taxes. And so at approximately the same time, we had this huge sea change in the market, where all of a sudden growth, which it took a few months after that for growth to blow off, but look what's happened. Now you have a pretty sharp decline in the relative strength of growth to value that's occurring right up to the moment. And so I believe we have a sea change. It could be that as it did back in 2000, it might be where both growth and value have to go through some kind of a bear market together, or it could be that we have growth take a steeper tumble like back in 83, 84, and value has less of a tumble, or maybe just goes into a trading range for a period of time. But there's a rotation that's occurring here. And this rotation and the orientation of this rotation is going to be that growth is going to, I think, stall here, and value is going to take over. And if we are aware of that and we use the right tools, we'll be able to identify where our capital can work the hardest. And of course, the stockcharts.com has the very best tools for being able to do this. So one last chart on this, and that is that what I've done is I've taken the Vanguard Value ETF and the Vanguard Growth ETF, and I put them up for the entire bull market going back to 2009. And then here's a relative strength with growth when the line is rising, as on the other charts, growth is leading, and as the line turns the other way, value is leading, as defined by these two ETFs. And so you can see here that we had somewhat of a blow off that occurred into 2018, and now you can see that there's a pretty good decline that has occurred off of that peak, which indicates that value is starting to dominate over growth. And so I think we're at a point in time where we want to start to think about how we want to rotate our portfolios to benefit from this change. So let's now look at some specific examples. So here, I'll have to keep track of time here. Here is a chart, an ETF that I have been following since late June, and it is my proxy for the FAANG stocks. And so this is the First Trust Internet Index, and the symbol is FDN. And we started to follow it back here at the end of June, and said that with this sharp break that we had in June, that FDN was going to go into a trading range, and for at least the third quarter. And in fact, that's just what it did. And then at the end of the third quarter, we wrote another blog that has the FDN at a hinge. So you can see how lower highs are being made, higher lows are being made, and it's coming into this hinge area where it's going to resolve itself one way or the other. And in fact, it resolved itself with a decline. You can see that this decline was dramatic. This is a very sharp decline for this index. 35% of this ETF is FAANG stocks. All the FAANG stocks are in here. And then there's other FAANG-like stocks that make up the rest of the portfolio. So you can see that this is a very sharp decline. And we have a point and figure chart that we have put up. And this point and figure chart counts down to 114, 110. And we've gotten as low as around 117. So there's still potential to go further. Now, the thing that we are wondering is whether or not this count could become even bigger. And so we're going to keep an eye on this, because a rally up into a lower high here could produce a count that could cross this entire area and make for a very large distribution count. So this is sort of anecdotal evidence, because these FAANG stocks are the type of growth stocks that have done so well in this bull market. So we've had this wonderful appreciation in these stocks, and now all of a sudden they're behaving very differently in 2018. And I think that's related to some of the changes in the way capital is being treated in the economy, and that also the growth of the economy, which is partly related to the way capital is being treated. Banks are willing to lend more to businesses and so on, is causing this rotation. And we want to benefit from this rotation. So here is one piece of anecdotal evidence. And the other thing I want to show you is in June 30th, we did this point and figure chart in the blog. And you can see that this accumulation area here earlier in the year was fulfilled. It came within 2 boxes of hitting the top objective of this point and figure count, the large one. And then from that point on, it became overbought in this trend channel, turned down, and now it's down to this, it's gone as low as this 117 area right here. So you can see this is a huge tumble for these stocks. Okay, so there's one example. Let's look at another. This is certainly one of America's favorite stocks. It's one of my favorite stocks. I love to follow it, analyze it. It's a great company. And this is Apple. And so Apple, you can see here that this is a blog that I wrote back in September of 2016, and you can go back and look at that. But here was a point and figure count, a reaccumulation count that was taken at that time. And that reaccumulation count, which was, arguably not finished yet, but we published the blog anyway, gave a count up to 204,197. And so that count, and there was a nice little distribution count in here too, and it came within one box of hitting it perfectly, is this reaccumulation count was generated with a count line at around 100. I think it was 96. And the Apple was 115 at the time. And it's jumped out of there. And let's look at what happened. So here's a current chart, point and figure chart of Apple. And what I did is, after this reaccumulation count here, which is the lower count, did complete, you can see it had one more push up and then a backup. I counted from that point across. It gave a count of 215, 231. And then there was a reaccumulation count that confirmed, and we love when this happens, it confirmed the lower count. They both matched, and look what happened with Apple. As soon as it got up into that area and touched that 231, 226 area, it stopped, turned back down. There was comments today, I think from Erin, about how Apple is trading right now, and you can see that there's a huge change of character here. Again, Apple's been one of our favorite big growth companies, and arguably has got great value too, but it's the emphasis of Apple is that it's one of our big growth leaders, and Apple has shown a change of character here. Now, this is not to suggest that Apple's in a bear market. This is just saying that Apple's going to need time to either reaccumulate itself for another move, or it's going to potentially even distribute itself. At this point, it's too early to tell, but we do know that we have used up the fuel in the tank here for higher prices, and Apple needs to take a rest and reaccumulate itself or distribute itself for the next move. Okay. This is a interesting chart of these markets that we have been discussing. So here's the S&P, here's the NASDAQ 100, the Dow, and the Russell. And so here we can see how much fuel is in the tank here for higher prices. So the yellow shaded areas represent the areas where I've taken point and figure counts, and we actually did these counts, and I believe we showed them in June here on Market Watchers Live. So you can see that these yellow counts, and this is the final peak, 2940 for the S&P, the NDX 7700, etc. I want to now show you the point and figure charts, and these are the actual counts that we put up at that time. And this is just a great indicator of how well these point and figure charts can help you with your trading. So we saw that at the time, back mid-year, that we had an account here, reaccumulation or an accumulation count that went up to 2950, 2990. And we missed that by one box, 2940.91. So these are 10-point boxes here. And the NDX, you can see that the NDX actually overshot this this small count and didn't quite reach the big count. But this is just, I mean, this is what a great tool this is, because this told us that accumulation had formed and prepared the NDX for an important move upwards, and it went up to 7,700. The Dow Industrials, which is one of my favorite for point and figure counting, here you can see that it went to 26,951, 952, and that split almost got up to the high count here on this base. And so we have fulfilled that count. And here, the most troublesome of the four big indexes really was the Russell, because the Russell 2000 was unable to complete its move on these two counts up to the 1830, 1850 area and only got up to 1742, which actually was a sign of weakness for the Russell, that it couldn't achieve its point and figure counts. And so I just wanted to show you those. And let's see, we have time. This is an interesting chart that kind of speaks to the current moment, and that is this is the Dow Industrials, and this is 5-minute data, 3-box reversal, 40-point scaling here. And so this is the recent well, let's call it a minor accumulation area that occurred after the big October decline. And I'm somewhat encouraged by this. And we have a smaller count here that was counted across and gave us an objective of 25,960 up to 26,320. Well, we got to 26,277, which put us right in the middle of this lower count. And then it's rolled over at that point. But I think there's reason to be encouraged. So if you can see this chart, this is that area right here that it rallied up into. Well, look what's happened since. So this is the area that we counted across here. Let me see if I can. So this is what we counted right here. And this takes us up to the smaller count, but look at this bigger count that's available to us. And so we can see that today that the Dow is making a slightly lower low, and quite honestly, it's back to this old resistance area, which is now new support. The thing in the near term that gives us caution is the amount of weakness that we've had off of this big peak here. But this is not unusual to have that kind of weakness. But it does say that there's a lot of supply latent in this market, and that what we need to see is we need to see the end of the decline, and then the ability to start to rally again and put a rally in, sort of like what we saw back here at the beginning of November, where it rallied up, was able to take out prior peaks and then pull back with shallow pullbacks and then have really good rallies again. So I believe that's possible. I think that this isn't surprising that there is still a lot of supply in this market. But if we can consolidate this and we can stop going down and start to do something akin to what we did off the spring and test here, and start to do the higher highs and higher lows, I believe that we could count this as a point and figure count, and this would generate a pretty big count. So, and this count here from the LPS over also is a pretty big count. So on that, that's what I have for now. But again, I think we're in a period of rotation. I think this rotation is very important. I think because of the current environment and how capital is being treated, I think that we're getting rotation, and this rotation is moving us towards other areas of the market, which is going to create an opportunity. And we just have to be on our toes to see where the money is flowing to. And I believe that the growth names are going to be a source of capital to go into the value names as time goes on from here. So that's what I got for now.
Okay. Well, first of all, I mean, I was just sitting here mesmerized. I'm sure a lot of the viewers are doing the same thing. I mean, I could listen to you talk for a long time about this stuff. It's very fascinating. And I think some of your earlier discussion about how, we're looking at a market for a while driven by growth stocks, and then it kind of rotates, and then you see the value stocks take over. I think that those are some compelling points, because we have seen a lot of these growth stocks, especially many of the software stocks, have gotten hit so hard over the past couple of months. And so there's certainly something to be said for the money that's been rotating. of late. I know in the room there was one well, there were a few questions, but I know one in particular about an individual stock, and we still have maybe a minute or two. I don't know if you can take a look at this one, Bruce. But how about O'Reilly? ORLY. Do you have any thoughts about that that stock and where we might be as far
Well,
as
I've been kind of intrigued with these auto parts companies, and see if we can make a picture here. So look at this. Now this is again a 30-minute chart. I'll go out to daily, but beautiful. Look at climactic decline, automatic rally, secondary test, and now look at the volatility come out of this. So this is the thing that we look for in Wyckoff, is this. The volatility just becomes lesser and lesser as we go along. We generally look for lower volume through this, but look at this resolution here, higher lows throughout, and now this beautiful rally upward from here. And look at how well O'Reilly's acting relative to the market as a whole. This is just really a very interesting looking stock. And then here's a daily. So beautiful. It's a reaccumulation structure, shakes out at the end and tests it, and now this beautiful rally. And so another one that I was looking at here, which is Advanced Auto Parts, similar story. I like them both. They look great.
Awesome.
So Tom, you may have some comments about this.
Well, I mean, I do. I don't specifically talk about, Wyckoff the way you do. I mean, I don't know all the terms and phrases, although I've learned a lot more from you since you've been coming on the show. But I do think I look a lot at stocks and charts in a Wyckoffian way.
Oh, I totally get that, because when I listen to you, and I'm a member of the audience, and when I listen to you, you exude it. There's no question.
Exude.
Because this is just good charting practice. Whether or not you use the terms of Wyckoff or you learned it with other terminology, it's just best practices for charting.
Well, and I think too, when you're looking at a chart, it's not just about, okay, did it go up or did it go down, or the MACD or the PPO or PMO did this, that, whatever. It's about the chart telling a story from a longer term perspective. I think under Wyckoff, when you're looking at these charts over the past, if you're looking at a daily chart, maybe the past couple of months, maybe a few weeks, and you're seeing what appears to be telling you a story about the stock, like here with Advanced Auto Parts or O'Reilly, where it kind of goes into that sideways, you get those huge moves down, then you get that automatic reaction back to the upside, and it establishes trading ranges for you to watch. And then depending on how the stock trades after that, kind of gives you a sense of whether or not the stock has a better chance of going higher or lower. And of course, with your point and figure and all coming out with many of those projections, it gives you not only whether you're bullish or bearish, but also gives you targets to look for, which is very important as well.
And of course, that's what I love about point and figure, and I'm just crazy for point and figure. But
yeah, you have to come on here more often and teach me about that, because
exactly.
I've just never really gotten into. I know Greg Schnell does it a lot, and I mean, I know some of the basics. I know enough to get me in trouble.
Yeah.
But your targets that you use, I've seen so many times that they play out to that. It's really fascinating stuff.
Well, I'm happy to do it, and I'm love talking about point and figure. Zach had me do a 2-part series for Stock Charts TV on point and figure basics, and every so often they re-show those, and so I encourage people to look for that. And so Zach, hint, it's like put it in the programming again, because I think it's a great primer on how to do this work. And then what it does is, so for instance, here's FireEye, which is a stock that we've talked about over time here, is this is a huge point and figure count. And this count, you can take it in segments. So you can take little pieces of it and then take the whole thing. And FireEye is now at the point where it's trying to break out above this resistance area. Now, I think it could have to do some more work here and maybe pause, but notice how the stock just does not want to go down with the market. And there are, and this is an important point to make here. It's like, I'm not against growth and just in value now. I'm just saying there's always great ideas in both areas. But as a general theme, where's the money flowing from and where's it flowing to? And the other thing that's attacking the stock market here is that when the economy gets hot, and here we have a near a 3.5% GDP economy, well, now the economy is starting to take money away from financial assets. It's become competition with financial assets for funds. And so this is what happens when you get late in the cycle and the economy gets real hot, is not only is there competition between stocks and bonds and other financial assets, but now the real economy, which is, the elephant in the room, is starting to draw money away from the stock market. And so it's all competition. It's all about money flow.
Mm-hmm. All right. Well, I tell you what, if you can hang around, I think you agreed that you're going to stick around with us for agree, disagree at the end of the show.
Happy to. Yeah.
We're going to jump in, do the 10 in 10, get a quick market update, and we're going to come back. You're going to join us for that segment. I think it's a great topic, really fits in with what we've been talking about all day so far. So hang in there with us, please, if you don't mind.
I'm here.
All right.
Thank you.
Excellent.
No,
all right. I got your 10 in 10.
Let's do it.
Getting it started here. Let's go ahead and get that RRG up for us right there. Okay. So, we had a few outliers here. It looks like a lot of them going in that southwest direction, not the direction you really want to see on an RRG. And then we didn't have a whole lot of requests, and I always, whenever that happens, I always congratulate our guests, because that means people were just watching with bated breath the whole time, didn't even have time to give us some symbol requests. So if you are in the room, go ahead and like the symbols that were put up there. The most popular will be our second symbol, but our first one is Johnson & Johnson.
All right, let's take a look. First, I'm going to say I'm changing my tune a little bit here on Johnson & Johnson. I've liked the stock because it's been in an uptrend, but I've just liked other pharmas better. But I think I'm beginning to change my tune on this one. I think Johnson & Johnson's starting to show some really good relative outperformance. You can see that the recent break to the upside here took out the September high. We have not seen that on the pharmas, so we're beginning to see some relative strength in Johnson & Johnson. Short term, I think we might have a little bit of issue. We had a reversing candle yesterday right near that January high. So I think a pullback maybe to that rising 20-day moving average could be in the cards in the near term. But when you look at this chart now, you've got the pharmas rising. You've got Johnson & Johnson moving back up and breaking above a recent relative high, so a relative resistance. So I think you've got this stock performing well now on a relative basis. J&J's been outperforming the S&P because of the group, and you can see the group doing very well. So I think now you've got everything lined up here pretty good for Johnson & Johnson. The only thing is, I think because we're at resistance, at January resistance, maybe we see a short-term pullback here.
All right. The most popular in the chat room, and actually I've been involved in a lot of chatter with this one. I picked it in September 20th. I was looking at natural gas, UNG. I wrote about it in my blog September 20th, and of course it has been taking off. I own it, thankfully. But I was telling everybody it looks pretty parabolic to me, so I'd get that trailing stop in there if you are in it.
Yeah, I mean, this is obviously it's hard to even look to see where any resistance is, but let's take a look at a 2-year chart here. Yeah, it's getting up close to the high. I'm going to go back even further. Let's go 5 years and look at a weekly chart and try to find some key areas of resistance. Yeah, this was a reaction high. Actually, I would agree. I mean, I think this is, I don't know if it's been parabolic relative to where it's been in the past, but certainly over the last month or two, this has been a huge move to the upside. And I think there is reason to believe that it could struggle here in the upper 30s. We do have, a downtrend, a series of lower lows, lower reaction highs. And here we did put in a lower low. I think we need to clear this 39 area on a closing basis from a weekly perspective. So this is right about where you might see some sellers coming in. A lot of volume coming in. I think there's some positives here. But because it's made such a big move and we're up against resistance, I would probably be thinking about taking profits as well.
All right.
Tom and Erin, I published a blog yesterday on UNG with point and figure counts. And so just everybody can have a look at those. And 4067 is my near term point and figure target.
Wow.
There's bigger ones, but that's the near term target.
Yeah, I was looking at $39. So wow, right there.
Sweet.
All right, let's see. Next one. How about Home Depot HD?
All right, Home Depot just reported, went down, got close to price support, very heavy volume, but did reverse. I just think right now it's short term in a trading range. So for Home Depot, I would be looking at, we had a couple of lows down around 190. We broke down. You can see the volume pick up, moved back up, couldn't get through 190. And now I believe we're just sitting in this trading range between about 172.5 and 190. Currently trading at 180 right in the middle. I don't see anything to do just yet. But I would definitely be watching that support level in late October.
All right. Next one. We actually haven't looked at this in over a week. Square, SQ.
Yeah, the financial administration stocks, kind of like software. I mean, they looked so good for so long, and now they're struggling. And I think in the near term, they probably deserve some consolidation. We did break below a key area of support. There was gap support from back here in August. We had gapped up. We came down, tested it again, and then look at the volume pickup as we broke below. We come back up. Broken support becomes resistance right here in the 82.5 to 83, 84 area, and now we move down. I think right now I would be watching this 64.5 level to the downside and maybe 83, 84 top side as we consolidate. So I think, again, below the 20-day moving average, moving lower, I don't see anything at this point, because if I get in here, I'm not going to be very happy if it goes down test support. I'm going to already be down about 8% on the stock. So I would be holding off and waiting until perhaps support's tested down around 64.5.
All right. Next one up, Constellation Brands, STZ.
Yeah, I talked a little bit about the distillers and vintners yesterday. I don't like the group. I think they have broken down on the longer chart. I don't like this test of Constellation Brands coming up to the 20-day and failing with that reversing bearish engulfing candle. And for those of you maybe who are not candlestick fans, let me just show you what I'm referring to here. But that right there is a reversing candle. So you got an uptrend, you hit the 20-day moving average, reversing bearish engulfing, and then back down we go. I do think that the short-term price support needs to be watched closely, but I'll be honest, I don't think it's going to hold based on the longer-term weekly chart. So I would be watching this as short-term support. Maybe we bounce one more time to that 20-day moving average, maybe off a downtrend, we get a descending triangle or something like that. But that would be kind of like best-case scenario for me. We may go right through. I don't like the long-term chart, so I'm going to avoid STZ.
All right. How about a semiconductor, Texas Instruments, TXN?
All right. Not too excited about the semiconductors just yet either. So we're downtrending, clearly lower lows, lower highs. Capitulatory low, so we'll have to see whether or not that holds to the downside. But I am looking at this recent. I mean, you could go all the way down to the intraday low, but I normally use candle bodies where they open or close. So I'm going to say right around 88.5, 89 is key support that I'd want to watch here to the downside. Back to the upside, I think you're going to have a couple of key levels. One, you can see the breakdown. There was support, broke down, tested it, and then came back down below this level, broke it to the downside. We've been struggling around 98. There's a lot of levels here, but I think we are in a downtrend. I suspect we're going to head back to that 89 area and test support.
All righty. Let's see. The next one is an industrial for you. Federal Signal Corp, FSS, in commercial vehicles.
Yeah, making a nice move today. Can we get back above that reaction high? I'm going to say 24.5, 24.75 has been pretty important resistance, actually probably 24.50 to about 24.60 right in here. You see a lot of tops coming in, failures right at about this level, going all the way back the last 6 months. We're up there again. We got overall, I think we've kind of fell apart, losing this prior support area. Maybe that was just a little false breakdown. Volume wasn't overly high to the downside. But I think to the upside, you got the 50-day moving average and fairly significant overhead resistance approaching. So if I was in it as a short-term trader, I'd take my money and run and then see if we can get the breakout.
Okay. Next one, Celgene, CELG.
Yeah, I'd like to say I feel better about the biotechs and Celgene, but that's not the case either. So I think right now you've got a lot of areas that are breaking down below their earlier lows that we saw in October. Biotech's one of them, and you can see Celgene breaking down. So here we broke down below this high volume low that was established back in May, which was around 74.75. Came back up a little bit above that area, but we didn't get through the 20-day moving average, and now we're breaking to new lows. One positive here, and that positive is that we have lower price, higher PPO on this daily chart. So maybe if we get a reversing candle, I could take a shot. That would signal maybe we could get a 50-day test as opposed to the 20. That's the way I use these divergences. But still, the overall volume trends are down. At this point, we don't know what's going to happen to that PPO. We've broken down. So unless we get a reversing candle, I'm thinking price continues going lower. So I don't jump in too early on these what look like positive divergences, because if the selling continues, we could see that PPO eliminate that negative, or excuse me, that positive divergence. So I'm going to pass for now and just keep it on a watch list.
All right. Here's another one in healthcare that has a very nice RRG heading, RadNet, RDNT.
Yeah, I don't like this at all. Big volume sell-off, breaking below prior lows. This is now looking like some kind of a false breakout here back in October. So you can see the overhead resistance was pretty clear. We had a false breakout here. Then we actually closed above it, couldn't hold it, and now we have been back down. Look at the volume confirming this move to the downside. A couple areas of support. We already lost one at about 1330, 1335. And now we're looking at probably moving down to test that 1275 area. We'll see if it holds.
All right. And then our final one from the real estate sector, Innovative Industrial Properties, IIPR.
Don't know that one.
Yeah.
Yeah, not a lot of volume on it. And we are trying to get back up near resistance. I think that this is in a pretty nice pattern. So I like the stock. I just wouldn't buy it here because you're getting so close to resistance. But off of an uptrend, I think the these reaction lows coming back down here in the 40-41 area, I think provides great support now. The high that we saw at the beginning of October establishes resistance. I wouldn't be surprised if we consolidate in this range. So for now, I would be a seller in the upper 40s.
Okay. And that does complete the 10 and 10. Here are the symbols we just went over. I will have these up in the Market Watchers Live chart list right after the show. Just go to the blogs tab and click on the Market Watchers Live blog, and the link is at the top, and of course in every recap that I write at the end of the day. All right, time for our final market update. Let's go ahead and see what is going on right now in the market. All right, still looking at a down day going on right now. The Dow Jones now is down over 177 points, about 0.7% right now. You can see most of the markets did open to the upside, but have been really trickling lower and lower and lower. S&P 500 currently down 0.65%. NASDAQ continues to slide, and it is down 0.71% currently. OEX is also lower on the day. S&P 400 small caps also seem to be having difficulties today to the downside. Although I'm looking at Russell 2000, we may have found a little bit of an intraday support level. We'll have to check that out later. TSX Canadian markets are down. Treasury yields lower on the day, 3.12%. UUP heading back up after a difficult morning, still in the negative, but only down about 2 cents, 25.91, the price for UUP. Gold had a big move in the last half hour to the upside. Currently, GLD is now up 54 cents at 114.24. And we can see TLT, another one that it had the huge gap to the low, down this morning and has made great strides and has managed to get itself back up to on Monday's, the intraday high there. And USO is now up on the day a little bit. We've got it breaking out. It's up 34 cents, currently at $12.03. And that's all I have for my market update. What you got for us, Tom?
All right, just a really quick chart in my blog earlier this morning under the current outlook. I just put in here, you can see that when the market is trending in one direction or the other, you need to watch the 20-period moving average. So this is an hourly chart. So I'm looking at the 20-period or the 20-hour exponential moving average as resistance. Notice yesterday when we had the rally, we hit that 20 and we dropped. This morning we opened up, hit that 20 period, and once again we dropped. Now, I didn't draw this line coming across here because this is a live chart now, but you can see right around 2,700, that's where we gapped up, started that huge uptrend. You also could see what could be a neckline here, and now we have moved down, established what could be a reverse right shoulder. So this is going to be an interesting test this afternoon on the S&P 500. Can we hold the support area around 2,700? And if we do, can we get back up through that 20-day moving average? All right, we are going to move into our final segment of the day. This is agree or disagree. If you had a chance to respond to the poll that we had up today, essentially what we were saying is that the FAANG stocks have been really weak, and that's led to underperformance in the NASDAQ 100 relative to the S&P 500. I know Bruce spent some time earlier talking about how we've been seeing underperformance in those growth stocks. So the question is, for the balance of 2018, is this underperformance and this weakness in the FAANG going to continue to lead the NASDAQ 100 to underperform the S&P 500? Is it going to, or I guess I shouldn't be putting this in question format, it is going to lead to additional weakness in the balance of 2018. So I'm going to let Erin, you go first. Bruce, you can chime in second. I'll go third. We each have, 4 or 5 minutes, something like that. What do you think, Erin? Do you agree or disagree?
All right, I do agree. I would be putting those stocks, basically technology, a little bit on the back burner. If you want to hold some, you could. But I went ahead and put a candle glance together to show you what, on my candle glance, what these FAANG stocks look like. And I think it tells a story, a big time story about the weakness going on here. A couple of major characteristics, these intermediate term trend model neutral, and I think they're all neutral signals at this point because they did come, those crossovers, above the 200-day EMA. But we can see most of these have now had these intermediate term trend model neutral signals up, and the big ones that you should note is we've actually had some long-term trend model crossovers here. Those don't come that often, and Facebook got its long-term trend model sell signal back in September and has continued lower since then. And we can also see now Google today, it looks like the 50-day EMA is going to cross below that 200-day EMA, and that's another long-term trend model sell signal. So when I see these intermediate term neutrals and I see these long-term sell signals coming in here, Netflix, although it doesn't have that 50-200 crossover, it's about ready to. The intermediate term trend model here is on that neutral for Netflix. Looking at all of these stocks, I just don't see, there's just still too much weakness. All of my trend models are saying stay away.
All right, I think that's fair.
Mm-hmm.
Bruce, you got any thoughts? You want to chime in? You got 5 minutes. What do you think?
Well, you saw my FAANG surrogate in FDN, and just to take a slightly different tact here is I think what's happening. Look at this big distribution that we have here in FDN, and we have the potential for an even bigger point figure count than the one that we profiled that goes down to 110. I think that the fourth quarter is going to be difficult for institutions because they way over-own these FAANG stocks. They're large cap. They've overemphasized them. They've been able to create additional performance in their portfolios by being heavily weighted in them. I believe that now they're finding themselves to be significantly, seriously underperforming the indexes in the market, which is weak. Market is weak, and they're weaker. And that's that relative strength chart that I showed in the first part of my presentation, is that they growth stocks blow off and then they underperform, and they underperform for a long period of time. This takes years for growth to become overbought, takes years for value to become overbought, etc. Now, having said that, I believe that December 31st of 2018 is going to be like a magnet for these FAANG stocks, because these institutions are going to be systematically selling these stocks all the way into the end of the year. And the reason that they're going to be doing this, I believe, this is just my opinion, is that they're going to want to show that they're not overweighted in FAANG. They're not going to be able to sell their entire positions, but they're going to sell down to what the FAANG stocks would represent in a typical portfolio, say its normal weighting in the S&P 500 or the NASDAQ 100, which is our discussion here. So they're going to sell down to the weighting of the NASDAQ 100 or less, and that's going to be a lot of stock for them to sell between now and December 31st. So it's a little bit different tact on this, but I believe that the institutions are behind the 8 ball when it comes to FAANG stocks.
All right, so you agree.
I just had to find a 4-minute way to say that.
No, you did very well, I think. I think we all have good explanations. What about you, Tom?
Oh, wow. You know, I'm generally bullish, so it's really hard for me to agree with that statement. I almost need a third answer. I don't know.
Well, come on now. Everybody has that answer.
Yeah, I know. Oh my gosh, what do I want to do here? I've been looking at this at many different angles. Let me go through a couple of things I'm thinking about, and then I'll save my answer because I don't even know what my answer is still. But let's take a look at a chart. This is the NDX relative to the S&P 500 throughout this bull market. So this is the NASDAQ. This isn't just plotting the NASDAQ. This is how it is performing relative to the S&P. So when we talk about, many of the high growth areas, we do go through periods, and you'll see these in these, you see back in 2012, 2013, we have periods where we do pull back, money rotates away from these high growth companies, and then it comes storming back in. And so I took the blue dotted line here and just took some short-term trend lines. And it does look to me like we are breaking down beneath this trend line. And in the past, that's spelled trouble for a period of time, maybe for at least a quarter, maybe a couple of quarters. So I'm thinking based on this chart that I would agree with the statement. But I'm not done. First of all, we got to think about, okay, the FAANG stocks and how much of the FAANG stocks, how much does it actually represent in the NASDAQ 100? So in the QQQ, which tracks the NASDAQ 100, Apple is 13.19%. Amazon is 9.73%. Google is 8.77%. Facebook, 4.57%. And Netflix is not listed in the top 10. And the 10th one is like 1.9%. So Netflix doesn't have a whole lot of weighting in the NASDAQ 100. Facebook, 4.5%, still not nearly as much. And Facebook is the one that I am not a fan of. So if I go in and put in Facebook and we take a look at the long-term weekly chart here, I think we have a breakdown. I don't have a candle chart, but I think if you connect these trend lines, I mean, I've said this before, I think that we have a major change in character on the Facebook chart. No doubt about it. I don't like Facebook. I've talked about it many times ever since they came out with that debacle of an earnings report back in July, where They cut their operating margins, never told anybody on Wall Street. It was trading at an all-time high before they had a major announcement with their operating margins going forward. You don't get the trust back on Wall Street very quickly when you do that. So I believe Facebook, and I said it before, I think Facebook's going down to 100. But it's not going to put that much pressure. Even if it does, it won't put that much pressure on the NASDAQ 100 because, like I said, it is only about 4.5% of the QQQ. So that brings me to Apple, which is the number one stock. Well, I'm still looking at an uptrend here. Yes, it's pulled back. Let me go ahead and I will switch to the candlesticks. It's probably a good thing everyone took less time so that I could have more time.
Clearly, you were the more ambivalent.
Yeah. Let me get back to those candlestick charts. Well, I'm still trying to convince myself.
Yeah, Apple, I don't like. I really don't. And, you know, when I looked at my candle glance, I mean, I thought of all of them, it looked the weakest. And, you know, that's a big problem for the NASDAQ 100.
Well, Apple looked really good in the third quarter. So it's pulling back, but it's very close to where it had broken out from. I can be okay with Apple. I mean, for me, there's no question. I think Facebook looks the worst. I mean, here, got a trend line break. We keep failing at the 20-week moving average. It's below the 50. That's the one to me of the FAANG stocks I believe is the weakest. Apple has been weak, very weak of late, but it was at an all-time high literally 6 weeks ago. And the pullback was justified based on the huge move that it had to the upside. So, and I could connect some, some recent bottom, well, not recent bottoms, some major bottoms throughout this bull market. And I'm still trading above that on Apple. So I think Apple still looks okay. Amazon, I think it still looks okay. We had a massive rise on Amazon. I think it deserves a little bit of selling. We've seen it before on Amazon, and each time we get these pullbacks and everyone's ready to throw the towel in on Amazon, it just goes to a new high. So I think that Apple I'm okay with, Amazon I'm okay with. I think Google is getting dragged down with many of the internet stocks. I think as long as Google can hold on to about 1,000 price support, maybe 980 to 1,000 in that area, I think Google is still okay from a longer term perspective. Short term, I agree with you. I think some of these stocks are broken, but that's what typically happens when you go through a correction. So now the other one that needs to be mentioned here is Microsoft, though. Microsoft is 10% of the NASDAQ 100. It's not part of FAANG, but I think Microsoft looks pretty good here. So you're talking about Apple, Amazon, Google, and Microsoft, all, in my opinion, have not broken down on a long-term basis, and they represent about 42% of the NASDAQ 100, the QQQ. So based on that, I am going to say, all right, let me add one more thing. Yeah, I'm not ready to give you my answer just yet. So here's the NASDAQ.
Our producer is going to kill you, you know, if you don't give her an answer soon.
I'm on the edge of my seat.
What was that, Bruce?
I'm on the edge of my seat.
Yeah, I bet you are. All right, the NASDAQ 100 seasonally relative to the S&P 500 underperforms in December. Only goes up relative to the S&P 32% of the time. So I was ready to make a decision earlier, and then I pulled this up, and I'm like, darn it. Can't find any confirmation. So, all right, putting it all together, seasonality is kind of on the back burner. I use that really to confirm. Obviously, I'm not getting that confirmation here. I'm going to disagree. I think that every time Apple, Amazon, Microsoft, Google, when they pull back, they have been opportunities to buy. And those four, in my opinion, on the long-term chart are back near 50-day moving averages or major price support that I think could be bought from a longer-term perspective. Now, if those levels are lost, the ones I just showed on the charts, I mean, I would say, Apple, if it goes down below, say, about 180, Google goes down below about 980. Some of those levels that I gave, Amazon, which has held the 50-week moving average for quite a while, you start losing those, especially if we go below all of the October lows and more specifically those January lows, February lows, then I think we got a whole different ball game. But I think we're in a correction. I think the market still is going to go higher. So I'm going to disagree. How's that?
Oh.
So I used up all the time that you all did.
I know, my goodness. But you know what? I think you had a bit a tougher case to prove, in my opinion.
Yeah, I agree. I was even struggling to prove to myself.
Yes, you're kind of like Julius. I know whenever he's come on and we've done agree, disagree, he always wants to take the opposite. So he even waits until I give him the answer, and then he'll just take the other one. So
somehow I knew I was going to be in the minority here.
Well, my footnote would be that after the new year, I think the FAANG stocks or the NASDAQ 100 could be a fabulous trade.
yes.
That's sort of the way I'm looking at it.
Say that again, Bruce.
That after the first of the year, I think that the NASDAQ 100 or the FAANG trade could be a really good trade. So I just think that it's going to be in the new year.
It's funny you should mention that, because I'm going to go ahead and take the screen here in just a second. And I'm going to share with you that seasonality chart, because where December is a relatively poor month for the NASDAQ 100, January is a very good month. So here is your January. It's the NDX has outperformed the S&P 500 65% of January's, and look at the percentage. That's a big percentage. Only October has shown more strength on the NASDAQ versus the S&P 500. So that kind of fits right in with what you're thinking, Bruce. And the NASDAQ's best month of the year is January. The S&P 500 is December, but January for the NASDAQ.
Yeah, but what is that? So I guess, okay, it's up in October, normally almost 2%, 75% of the time.
Yep.
And we had a bad October.
Yep, which means if we take out 1 year, you can see it was 2.1% before this last year. So, I mean, and it was 79%. Nothing on here is 100%, by the way. We have no guarantees in the stock market, whether you use technical analysis, Ouija boards, or whatever you want to use. There's no guarantees on anything. So, yeah, I mean, it happens from time to time. That's why I use it more to confirm what I'm seeing on the charts, rather than using seasonality as my go-to, or I'm going to invest because seasonality tells me to invest. I don't use it that way.
Right. Or not to, based on that. So, yeah, my concern is like it normally is up, and then we had such a bad October. Is that a harbinger of bad things to come?
It's possible. I mean, usually October is good, although I will say 2007, the bear market started from the high on October 10th. So it does happen that the fourth quarter can begin a bear market. I'm not saying it doesn't, but I don't believe this is one.
All right.
Bruce, what do you say? I mean, do you think this is a bear market? We got about 45 seconds.
No, I think that we're in a massive trading range, and that there's a lot to like about this market. And I'm going to spend my time trying to find the new leadership. Okay. And it may take a few more months for it to really show up.
Well, it's interesting you say that, because we do talk a lot about, relative strength, and we've seen areas of the market that are starting to lead. Many of the healthcare areas, especially healthcare providers. I mean, those are areas I think maybe you're talking about. Okay, Bruce, it is always a pleasure to have you on the show. Thank you so much for joining us, and we look forward to having you back soon.
So much fun to be here. I appreciate it, everybody. Thank you.
Yeah, we always have so much fun when you're on the show. There is your upcoming schedule. We got a bunch of good stuff coming up. Do want to mention to everybody, we're not going to be here for Thanksgiving. Just want to let you know. No big shocker there, but also we won't be here for the Friday after. Thanks to everybody for joining us again. Thank you, Bruce, for that special visit today. Please remember to complete the survey as you exit. We love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. See you back here tomorrow. Happy trading.